Thank you for joining Jennifer Schaus and Associates in our 2019 Webinar Wednesday series. We're coming to you live from downtown Washington, D.C. Our webinars are every Wednesday, and you can find the upcoming schedule on our website. Past webinars and all recordings are also on our website and on our YouTube channel, along with over 160 other recordings on federal contracting topics. All are complimentary. If you have questions for our speakers today, you can email them directly with the contact information you'll see on the last slide. All right, there's just a little bit about us. We are a Washington, D.C.-based firm and provide services for federal contractors. This ranges from market analysis reports to proposal writing and also postal work compliance. More information is on our website, so please visit us there. We do offer advertising in our newsletter, so you can reach out to this email if you'd like more information on that. All right, our speaker today is Christian Nagel, and he's going to be going over government contracts valuation. Thank you for joining us today, Christian. I'm going to go ahead and hand it over to you.
Okay, thank you. Again, my name is Christian Nagel, and I'm with the law firm of Holland & Knight. We can move to the next slide, please. I'm not seeing the slides move on my... There we go. In any event, my name is Christian Nagel. I'm, again, with the law firm Holland & Knight. My background was in the Marine Corps before I went into private practice, and my practice focuses on government contracting, and so compliance as well as government contracting disputes. And I do work within the mergers and acquisition field in that realm as well, in the sense that oftentimes government contractors are looking for legal expertise to understand either the sell or buy side, to understand how the transaction should be valued, and what the potential risks are from a government contracts perspective. So that'll be the sort of viewpoint that I'm offering here, and obviously a CPA and or appraiser can get further in the weeds in terms of the numbers of it, but from my perspective and what I do, the hope is to be able to explain some of the value pieces of a merger and acquisition, and how that interplays with the federal government contracting space. So in terms of understanding how government contractors typically are valued in mergers and acquisitions, let's start with, we have the slide up here with the key value drivers. And I think of these things broken up into two sort of buckets loosely. One is quantitative and one is qualitative. And sort of scoping back a little bit, you know, this is not an objective thing, obviously, and at the end of the day, on the sell side, if you're looking to sell your company, really what matters is what one company is willing to offer to buy it. So we're not going to get sort of a strict market value for the most part, especially with privately held companies. But what we can do is get a sense of what a price might be in order to determine whether this is the right time for an exit strategy. And then oftentimes companies will use third-party brokers or bankers to try to sell their company. In that case, oftentimes you can, those brokers will have relationships with potential buyers. And so, of course, part of the goal as well as of understanding what the price might be is also to drive competition between potential buyers. And so it's oftentimes advantageous to understand how they see the world in an effort to try to drive up the value for the government contractor that's trying to sell. And so we think about government contracting from a high level, where oftentimes you could think about it in three ways. A contractor obviously is going to have some sort of desired products or services that the government wants. They will have customer relationships with the government, with the federal agency. And then thirdly, they'll have contracts in place with those customers. And as a general matter, a buyer of a contractor is looking to buy at least two and maybe all three of those things. And so if you kind of take nothing else away, that's, in the Marine Corps, we used to say, turn the map around and look at it from the other person's perspective. And that's a valuable exercise. And so from a seller perspective, the question is, what of those three things do we have to offer? And what is likely to drive value for a potential buyer? So let's drive down into some of the specifics, again, broken up into these two categories that we see on the slide here, quantitative and qualitative. As far as quantitative factors, obviously cash flow is almost always the most important thing for a potential buyer in terms of a metric to look at. And that is really pretty black and white. But when you drill down a little bit further into some of the details, you can find some other metrics that matter. One of them being revenue growth, kind of hand in hand with cash flow. But what is the sustainability of the medium to long-term revenue growth of this company? What do we see maybe 3 to 5 years out? And look at the buyer's going to also look at the customer base of that company. So what is the customer's long-term, short, long, medium-term prognosis? Is this a federal customer whose budgets and needs are going to be increasing in the coming years? And does the seller, the target, do their offerings meet what those increased budgets likely will align with? Other things that buyers tend to look at, the EBITDA margin, scale, client concentration. We're the top 5 clients that this government contractor works with. And obviously, the broader the client base, sort of the further spread the risk is, and therefore the more beneficial to the buyer. Are the contracts that the seller has, are they small business set-aside contracts? And obviously, if you're in this space, almost inevitably, when a small business is bought, it is no longer considered small because it will be affiliated with the purchaser. And once the two companies are affiliated, then the revenues are joined together for purposes of determining whether the company is small or not. And so generally, you're going to lose that small business set-aside. And so if all of the company's business is small business set-aside work, and there's no prognosis over the horizon for expanding into full and open, that's generally going to shrink down the value of the company. And conversely, if there's a lot of full and open work, even if the company is small, even if the company does have some set-aside work, and we'll talk about that more in a few minutes in terms of how those things work together. But if the company's got full and open work, then that's generally going to drive value up. So those are some of the more black and white quantitative values. On the qualitative side, it's a little bit harder to pin down on in terms of numbers. Things like market position. Is this company really the only one or one of a very few that are providing this particular good or service to the government? Market growth, again, as we talked about, does this seem like something that in the future will be an attractive proposition to the government customer? Desirable market segments, and this really gets into how the two companies could potentially work together. So is the buyer in a business where they could use the capabilities of the seller, and that those two things come together and offer a better platform for the government, a wider array of potential contracts that the resulting company, after the acquisition, that the resulting company could go after. Technical capabilities. Is there something that you can offer as the seller, as the government contractor, that may be attractive, obviously in the government space, also in the commercial space? These are all things that we want to start kind of lining up as ammunition to explain why the value should be driven higher. And it should be sort of a finite list of, we say, here's where, as a seller, we can help you as a buyer. Certifications, things like facilities clearances and personnel security, things that will typically transfer along with the assets of the company, and then the management team, right? This is a hard one to pin down in terms of dollars and cents, but how easy is it to transition from the current government contractor owner to a new potential management team? And so you look at things like, is this an owner who's really driving the day-to-day operations of the company? Is this an owner who owns the relationships with the government customer? Or is this an owner who has pushed those relationships down within his or her management team so that if there was a transition, you wouldn't lose all of the institutional knowledge, you wouldn't lose all of the relationships that have been developed in the previous years with the government customer? So hard to pin down, but if you can look at it again from the buyer's perspective, in terms of this would be an easy transition, the people who will move easily into the contract, and the owner isn't absolutely essential to each one of these contracts and to the success and to the future business development function of the company. So those are some of the most important value drivers. If we can move on to the next slide. Let's look at some of the legal considerations that also drive value. And these are things that I look at when I'm evaluating a merger and acquisition transaction. Being proactive is pretty obvious, but what do I mean by that? Look at compliance risk. Is there something specific that could be an issue that may not have surfaced yet? I'll tell you, in the diligence process, a sophisticated buyer is going to ask questions that will drill right down into this. So it's going to be very difficult. If there's a percolating issue, it's going to be very difficult to keep that hidden. And frankly, you don't want to keep it hidden because a typical asset or stock purchase agreement is going to include with it indemnification provisions, so that if there is something hidden that the buyer didn't know about and or the seller didn't produce as part of the diligence process, then that can circle back to the seller so that the seller has to indemnify the buyer. And so you really want all that stuff out so that as the seller, you're not on the hook for those additional costs down the road if there is a legal fight, if the company has to defend itself against the government investigation. So there really shouldn't be any surprises. So again, look at it from the buyer's perspective. Where are the potential risks? Is there something that's a compliance issue? Is there something that could be arguably a mandatory disclosure under the FAR rules? Is there something that could be a False Claims Act liability? Again, it likely will, and it should, for both the sake of both sides, it should come out during the diligence process. And those things are all things that are going to drive down value. And so it makes sense as a government contractor who's considering an exit strategy in the future to try to deal with those things now before going more actively into the market and trying to get those things. I've heard somebody say it takes twice as long to settle a compliance issue, to get it resolved, when you've got two parties involved, when the seller has the buyer breathing down their neck. And you have two senses of the right way to handle it, and all of a sudden things just become a lot more complicated. And so that's one. It should be a fix before you go to market, is that there's nothing hanging out there, and if there is, you've got a set resolution to it, and so that the buyer can really understand the parameters of its risk. And in terms of planning for an exit and other things you can do to be proactive about this. There may be a white knight buyer that comes in, but more likely it's going to take work and preparation and developing the business into a place where the exit strategy becomes more viable and the value is driven up. And so some of these issues, the legal issues, can go away. Tax issues is another one that comes up. If there's any kind of risk on that, the tax and compliance to me are the two where a buyer is going to say, this is risk that I can't get my arms around. And as a result, that's going to significantly impact the ultimate purchase price. All right, entity structure. So that's got to be something that should be a regular check. Again, long before the thought of a potential exit strategy is, are we in the right entity structure from a tax perspective, from a corporate liability perspective, and then flowing from that to tax and accounting issues. And so if you don't have an accountant who is very familiar with the federal contracting process, it makes all the sense in the world to get somebody on board early who can start shaping the tax and corporate structure in a way that's going to be more attractive to a potential buyer. Employee and benefit, something else that comes up in terms of driving the value of the company. Cash is king with employees, obviously, but there's all sorts of other additional incentive plans that you put in place that can be valuable in the near term, but also in a potential sale in terms of keeping folks on board and making a smooth transition and again, a better value proposition for a buyer. Things like equity in the company or even synthetic equity, stock share plans are all things that are going to be taken into account and will drive value. If we can go to the next slide, we'll look at a few more legal considerations. The small business death valley. So that's, again, if you've been in this business and done any kind of mergers and acquisition and have small business set aside, you're familiar with the problem of a really successful small business who then outgrows its standard. So under the NAICS standard, usually it's average revenue, and the company can't get a set aside contract if the average revenue for the past 5 years now, new rule, if the average revenue for the past 5 years exceeds a certain threshold. And so you get a situation where a company gets lots and lots of small business set-aside work, but grows too big and outgrows that size standard. So this is something that buyers are going to take a very close look at. As a general matter, it doesn't mean that the contracts are going to go away right away, but it does give the government that right. So the buyer is going to take that into account as far as risk factors. And it's possible that this federal agency is hugely reliant on the numbers they're generating from the set-aside work they have here. And as a result, they may terminate the contract for convenience. It rarely happens, but it could. Then you look at what is the size standard. From a small business perspective, most of them, as I said, it's going to be a 5-year look back and an average on that to get to your standard. And then do you have one of the larger or one of the smaller revenue bases? And there are some NAICS codes that are driven by employee counts. And so for those, obviously it's much easier to merge two companies together for one company to acquire another, because oftentimes there may be a 500-person employee limit, for example. So that's going to be an easier sell for a buyer, but all things that a buyer is going to look into. And then is this really a situation where the buyer is looking to take over the whole company, or is it one contract in particular? And oftentimes you'll see an IDIQ contract, so something like an Oasis contract or an Eagle, where it's basically a hunting license. So anybody who has that large IDIQ contract is allowed to go after task orders under that contract. That's really fundamentally what the buyer wants. The buyer wants that hunting license to go after work under that IDIQ contract. And if that's the case, then you've got to structure the deal a little bit differently. And frankly, it becomes a bit of a challenge to get the contract novated. And you have to figure out how you're, quote, selling a business because you really can't just sell a contract. And so that needs to be structured the right way. But again, something that's going to drive the value of the seller. We talked about the small business set-aside contracts and how that really devalues the contractor for the most part. And so the strategy there is to circle back to the initial, especially qualitative list of things that we went through. Yes, it may be a 3 to 5 year contract that's driving a lot of the cash flow of my company, but understand we have a deep relationship with this federal customer. We have technology that can be leveraged. We have a scope that can be expanded. It may be small business now, but it could go into full and open. And look at your federal customer. So the intelligence community, as an example, tends to care less about small business. And if you're in that space, it's an easier sell to a potential buyer than if you're working, for example, for HUD, who has very strict small business requirements and can even lose budget at HUD if they lose. So that's going to be a tougher sell for a contractor. All right, let's move on to the next slide. We just have a minute or two and look at a few more of these compliance issues that will be the top of the buyer's mind. Loss of small business status, again, I mentioned, and that's probably going to be first and foremost because the cash suddenly looks a lot more tenuous if it's tied to a small business set-aside contract. Typically, things like audits and investigations, the buyer is going to look at this as a liability risk. And so it's critically important to keep copies of communications with auditors and for mandatory disclosure purposes, for compliance process, and even things that are closed, frankly, they will come out in the diligence process. So it's critically important that those things are documented and that you've got the right story to tell with respect to any sort of previous audit or potential mandatory disclosure. As far as next slide, compliance risks in particular, one of the best counterweights to what the buyer is going to see as an open risk is a strong compliance program. And the good news with that is the Federal Acquisition Regulation, the FAR, has very specific list in FAR 52.203-13, which is incorporated into almost every federal contract. There's a very specific checklist, and that's more than likely going to be the checklist that the buyer uses. And as a result, it should be the checklist that a contractor uses when it's considering a potential exit. DOJ likewise has a similar list in its sentencing guidelines. And so these are things that you can get your arms around. and put in place prior to starting the process of an exit strategy. And we know that these are the things that the government's looking for. As a result, it's the things that the buyer's looking for. And as a result, it should be the thing that you're focused on as a contractor who's thinking about selling. OCI, organizational conflict of interest. These are things that come up where a contractor has additional information that other contractors wouldn't have, and as a result has an unfair advantage, or is where a contractor has developed the requirements for a contract, and as a result it would be unfair to let that contractor bid on the requirements that the contractor itself developed as part of a different contract. And so these are huge red flags, and it can happen on the buyer side or the seller side, where you are either have a close relationship such that you have an unfair advantage in a different contract, and then is there overlap between those two contracts that's going to cause a problem after a merger happens. So again, critically important to go through contracts and understand who the buyer is. And if the buyer is interested because of the business platform, the profitability, the interpersonal relationships, and sort of the understanding of the federal customer, all those things make perfect sense. On the other hand, if the buyer is interested in the contractor because of some information that the contractor has that could be useful in a different contract, it's worthwhile to take a step back and say, would this create an OCI? Would this create a conflict of interest? Novations, the last thing I'll touch on here. We only have a minute to go, but not typically required in a stock purchase, so long as the seller remains in control of the assets and continues to perform. But almost inevitably, a buyer is going to want an asset purchase, not a stock purchase, because the buyer doesn't want to assume the liabilities of the seller. And so with an asset purchase, you do need to novate the contracts, and this is something that can cause tremendous headache on the back end of a deal that's already done. And then post-closing, the parties have to go to the government and get the contracts novated from the seller to the buyer. And the problem here is that it's a completely discretionary act by the government. There's no timetable on it. There's no requirement that the government actually approve it. And as a result, it can cause tremendous headache, like I said. And so they have to create the legal structure in place while it's pending. Usually you have a subcontract in place until the novation is finalized. And you have to have a provision in place to unwind the deal, typically, if the novation is not approved. That's almost always what the seller is selling, is the relationship with the government and the government contracts. And so if the novation, for whatever reason, is disapproved, that needs to be taken into account. And again, will be a factor in terms of of how the buyer values the company. We're at 1:25, which is my deadline. But if we skip through to the end of the presentation, you'll see a few more of the topics I was hoping to hit, and you'll see my contact information. So I hope you reach out if there's follow-ups or any questions or anything I can clarify further. I appreciate your time on the webinar, and again, hope you'll reach out. Thank you.
Yeah, thank you, Christian, for joining us today. Like he mentioned, if you have any questions, please feel free to reach out by email or phone number. And this concludes the webinar. Thank you.